With the festive season in swing, many people will be wondering what to get the little ones in their family this Christmas. One way to steer clear of the shopping frenzy and give a gift that will last longer than any noisy toy or plastic tad is to put money aside for their future. As well as being a more prudent present than another short-lived must-have item, investing on behalf of children at a young age can be a great way to start building a pot for large future costs, such as university or a house purchase, says Joe Roxborough, a chartered financial planner at Ascot Lloyd. There are many ways in which you can make a financial gift to a child, whether as a simple one-off cash gift or by funding an investment on their behalf. As always, there are two key considerations: time horizon and the appropriate level of risk. Investors should think carefully about these factors. Keep the recipient in mind, not the donor, says Michael Owen, financial planning director at Brooks Macdonald. That means cautious parents or grandparents should not rule out stock market investments for their children or grandchildren, if the time horizon can support this. For those with a time frame of 5 years or more, equity-based investments have traditionally provided better overall returns than cash deposits. The compounding effect from reinvesting growth year on year is to the eventual size of the pot. A lump sum investment on behalf of a child is one of the best gifts you can ever give, says Oliver Smith, a portfolio manager at IG Smart Portfolios. Over the past 35 years, an investment in the FTSE All-Share Index ASX with dividends reinvested has gone up more than 21 times, averaging 9.3% a year. Within that time, the best 10-year period had an annualized return of 20.4%, while the worst, investing at the top of the market, an extremely powerful and can make a big difference, 1999, and selling at the bottom in March 2009 had a loss of just 0.6%. Junior ISA's Ben Willis, head of research at Whitechurch Securities, believes the Junior ISA GISA is probably the most appropriate vehicle for investing for children, due to its flexibility and tax efficiency. Money held in a GISA grows free of all tax, and can be rolled straight over into a grown-up ISA when the child comes of age. Meg Curry, investment director for personal investing at Fidelity International, is directing family and friends to her 1-year-old daughter's GISA when they ask what they should get her for Christmas. Unlike the latest toy fads, investing into a GISA isn't just for Christmas, it is a gift with long-term benefits, says Curry. The money is locked away until your child reaches 18, which means that even a small investment can grow to a sizable sum due to the magical power of compounding. Although parents have to open a GISA on behalf of their kids, anyone can contribute up to £4,128 in total in the 201,718 tax year. This can be held in cash, stocks and shares, or a combination of the two. The latest figures from HMRC show that cash remains the most popular. £525 million was saved into 569,000 cash accounts during the last tax year, compared to £333 million in 225,000 stocks and shares accounts. However, the best cash GISAs are only level pegging with inflation, which rose to a 5-year high of 3% in September, meaning the best you can hope for is that the money holds its value. Those gifting money to children, particularly young ones with an investment horizon of 10 years or more, can afford to take investment risk and stand to receive bigger rewards. If you tucked away £50 per month into a stocks and shares GISA tracking the FTSE All-Share Index over the past 5 years, for example, the pot would have grown to £3,813, compared to just £3,013 for a cash GISA, figures from MG show. This is even more important to consider in an environment where prices are rising faster than savings rates, says investment director Ritu Vohora. There are quite a few investment GISA providers, including our sister company Interactive Investor. Curry recommends using a set-and-forget fund, such as a low-cost, global tracker. The cheapest share class is of LG International Index Trust, which tracks FTSE World X UK Index, and Fidelity Index World, which tracks the MSCI World Index. Both cost 0.13%, or an actively managed fund with a global spread of investments, such as Rathbone Global Opportunities or Invesco Perpetual Global Equity Income. Investment trusts savings schemes for children are low cost and, unlike GISAs, don't have contribution limits or access restrictions. However, the flip side is that they can be less tax efficient as there is no built-in tax wrapper. For those willing to take some risk, there are a number of very good schemes allowing access to lower-cost investment trusts that have a broad spread of underlying investments, says Owen at Brooks Macdonald. Most schemes accept lump sums from £100 to £250, or regular contributions from £25 per month. Investment managers usually offer the choice of using a designated account or bare trust when investing for a child. With the former, you retain control of the investment, though it is treated as belonging to you for tax purposes. With the latter, the designated trustee, often a parent, automatically loses control of the investment when the child turns 18-16 in Scotland. However, the investment is treated as the child's for tax purposes, making this option particularly useful for higher-rate taxpayers or those adults likely to make use of their capital gains tax allowance. Another benefit of a bare trust is that the investment is treated as a potentially exempt transfer for inheritance tax purposes, meaning it falls out of your estate provided you live for at least 7 years after making the gift. Stock market investing doesn't suit all budgets and circumstances, though, so let's look at a variety of options for children, from those that give easy access and the least risk to capital to those that tie your money up for the long term and carry investment risk. Cash savings. Dedicated children's savings accounts often boast the most generous interest rates on the high street, with the top rates often offered to those who commit to making monthly contributions. These accounts hold money in the child's name and can be a good way to encourage children to save, says Adrian Locock, an investment director at Architas. HSBC pays 2.75% variable on deposits of £10 or more for children aged 7 to 17, while Saffron Building Society pays 4% fixed for a year for monthly contributions of £5 to £100 for children from birth to age 15. Both of these allow access to capital, so are useful for older children who want regular or ad hoc access, sometimes with parental approval. HSBC requires a parent's or guardian's signature for withdrawals of £50 or more for the under 11s. Children have tax allowances like adults, and therefore the first £1,000 of interest on savings per year is tax-free, unless the money comes from parents, in which case only the first £100 is tax-free. Premium bonds. For the under 16s, parents and grandparents can buy premium bonds, run by National Savings Investments (NSI), in the child's name. Instead of each bond paying interest individually, they are entered into a monthly prize draw with the chance to win between £25 and £1 million. On the plus side, all winnings are tax-free, but there is no guarantee I'll win anything at all, says Marlene Outram, managing director of UNIQ Family Wealth. Some children might like the idea of you winning a large sum. In my experience, you need a reasonable number of bonds to have a chance of getting a number of small wins, which might be quite a nice surprise. From the 1st of December 2017, the odds of a £1 bond winning have improved to 24,000 to 1. In addition, the annual premium bond prize fund interest rate has risen to 1.4% following the rise in the bank base rate, up from 1.25% in May. The maximum holding is £50,000, and you can cash in your bonds without notice or penalty. An alternative that has been garnering a growing following is the windfall bond from the Family Building Society. Each bond costs £10,000 and offers monthly prizes of between £1,000 and £50,000, although the odds of winning are worth 641 versus 31 for £10,000 worth of premium bonds. The windfall bond does pay interest at a variable rate equivalent to the Bank of England base rate, currently 0.25%. You have to be 18 to buy a bond, so an adult would have to hold one on behalf of a child, but Family Building Society is considering the introduction of a children's version. Accounts can be closed with 35 days notice. Pensions. Another way to give a child a financial leg up in life is by funding their pension. Contributing to children's pensions, at any age, gives them a great head start as they can't access the funds until they are much older, currently 55 years old, says Richard Morley, an investment manager at Prudent. Up to £2,880 can be saved in a pension for a non-earner per tax year. Basic rate tax relief means this is grossed up to £3,600. If that lump sum returned 5% a year, it would be worth £42,000 in 50 years' time, or £111,000 in 70 years' time, figures from Architas show. This article was originally published in our sister magazine Money Observer. Click here to subscribe. This article is for information and discussion purposes only and does not form a recommendation to invest, or otherwise. The value of an investment may fall. The investments referred to in this article may not be suitable for all investors, and if in doubt, an investor should seek advice from a qualified investment advisor.